Mortgage insurance versus term insurance. Aren't they the same thing? If not, is one better than the other? I'm Benny Zanetti, Certified Financial Planner, and it's time to dig a little deeper. If you've ever bought property, you've probably been exposed to mortgage insurance. It's usually sold in the office of the lender, and you fill out a relatively short application. And if you bought the place with your partner, and either you or your partner were to pass away, the mortgage would get paid. With term insurance, you have to meet with a licensed insurance professional. You fill out a much more in-depth application, and if necessary, you might have to provide medical samples like blood, urine, and maybe even a doctor's report. At that point, the application is sent off to the insurance company for review, at which time it's accepted with a rating, or declined. Why is the process for term insurance so much more in depth? Well, there's a lot of reasons, some of which might surprise you. With mortgage insurance, you might be surprised to know that the person who gets paid if one of you were to die is the lender. You also might be surprised to know that what they get paid is the value of the mortgage, which, if you're doing things right, is constantly going down. However, the premiums stay the same. With term insurance, whomever you name as beneficiary gets paid. They get paid the amount that you agree upon, say $500,000, for the entire term. And what about that term? Well, with term insurance, you agree on a term, say 10, maybe 20 years. With mortgage insurance, you decide you want to shop it around and go to a new lender. There's a good chance that you might have to renegotiate that contract with the insurance. And if something goes wrong with you along the way, if you get sick, you simply won't qualify. And the main reason the application process is so much more in depth with term insurance is something called underwriting at time of claim, as opposed to underwriting at time of application. You see, when you fill out an application with an insurance company and become accepted, it's a contract. The underwriting, the agreement, was made at the time of application. With mortgage insurance, they use a different process called underwriting at time of claim. It's at that point, at time of claim, that they can review the application and determine whether it was filled out properly. At that point, they can decide whether or not the insurance is valid. As you can see, this can have some really bad ramifications. So here's the point. Most of us don't even know if we have mortgage insurance or term insurance, but it never hurts to find out. Quotes are free. In the meantime, if you want to learn more about this, just Google this Marketplace episode. And if you want to learn even more, just email me. It's on the landing page of my website. In the meantime, stay happy, stay safe.